We've all seen Robert Kiyosaki in interviews and various videos. There is a video where he speaks about using debts to leverage tax, and mentioned that's why he does not pay taxes. Robert Kiyosaki explained how, but his examples clearly show that this process correlates to wealthy people. Robert Kiyosaki talks about how millionaires can reduce how much taxes they pay. We've done some digging and found great news. Anyone can apply this process and build on achieving financial freedom, whether you work as a business or as an employee. Yes, you heard me. Anyone. Now I got your attention. The first question would be, how can anyone use debts to pay even fewer taxes? In this video, we are explaining how would anyone use debt to pay fewer taxes. We have identified 3 essential steps. 1. You need to make yourself eligible to use debt to leverage taxes. 2. You need to understand and reprogram your income stream structure. 3. You need to have a clear plan on how to make the money leveraged from taxes to generate further income. In the next part of the video, we'll explain this as simply as possible. Step 1. How to make yourself eligible to use debt to leverage taxes. In other words, what do you need to do to be able to use debts to make money? The answer is, you need to change your income stream structure to a form of revenue, enabling you to use debts to pay fewer taxes. Or, make yourself adaptable to multiple income stream structures. What is an income stream structure? The simplest answer would be, it's the way you get paid. For example, when you work as an employee, you have a salary or a wage. When you run a business, you can pay yourself a salary or get dividends. These are the 2 income stream structures we'd focus on. The answer to step 1 is to change your income stream to the correct structure, enabling you to use debt to pay fewer taxes. Step 2. Understand and reprogram your income stream structure. How can you do that? We'll answer this question by explaining the difference between working as an employee and as a business in terms of taxes. When you're working as an employee, taxes are deducted before you get paid. Under this income stream structure, you have access to your money after paying taxes. You have no control. However, when you're working as a business, you deduct business expenses before paying taxes. Under this income stream structure, you have access to your money before paying taxes. You are in control. As an employee, you are subject to taxable brackets on your income, which you're not when working as a business as long as you don't pay yourself a salary. Note, if you already know the impact of working as a business to working as an employee in terms of taxes, you can skip to the next chapter. Here is a quick breakdown to understand how the taxable brackets impact you under both income stream structures. In this example, you are earning £60,000 a year as an employee. In the UK, for this tax year ending April 2023, your personal tax allowance is currently at £12,570 a year. This is how much of your earnings are tax-free. There are other tax codes with different rate allowances. You can find out about your tax allowance on your tax code. This can be found on your payslip or go to the HMRC website. After the allowance, you need to understand the salary tax threshold, which breaks down as follows. You pay 0% of tax on your first £12,570. This is your tax allowance. 20% of tax on earnings up to £37,700 excluding tax allowances. 40% of tax on earnings from £37,701 to £150,000. 45% on earning above £150,000. You can go to the HMRC website and check the latest update for free. This means if you are earning £60,000 a year, you would pay £11,432 on income tax and £5,668 on NI contribution. Your take-home would be roughly £42,900 per year, working as an employee. Note, this calculation doesn't include pension contributions, student loans, and other deductions likely to be applicable. You can request a video with more details about those. Feel free to do that in the comment section. The breakdown of the above calculation is as follows. Out of the 60k, you have £12,570 tax-free, leaving you with £47,430 from which you're taxed at 20% of the first £37,700, and lastly, you have £9,730 from which you are taxed at 40%. You pay £11,432 on income taxes for the year. Next, you have national insurance contributions, which are calculated in a similar way. NIC deductions follow the same logic, where 12% is deducted for earnings up to the primary threshold and 2% for earnings above the primary threshold. The mix impact of the threshold rate comes roughly to 9% of your gross salary, making a total of £5,668. The total deduction for the year would be £17,100 when working as an employee. If you are an employee, you do not have to worry about these calculations because your employer takes care of this process. However, knowing and understanding how much you pay is important. Now let's see the same revenue working as a business. Working as a business, making £60,000 per year, how much you pay in taxes depends on how much it costs to run your business. The tax rate in the UK is currently at 19%. Assuming it cost you £25,000 to run your business for the year, you would pay 60k minus 25k, gives you an operating profit of 35k, deducting 19% tax, which is equivalent to £6,650, leaving with a net profit of £28,350. You can pay yourself a dividend. More about how dividend deduction are calculated on another video if requested. Let's summarize. As an employee, earning 60k per annum means paying 17.1k in taxes and deductions, taking home 42.9k. As a business, making a 60k turnover means paying 6.6k in taxes, which depends on how much your expenses are. You have 53.4k at your disposal because you are in control of your expenses. In terms of percentage in this example, as an employee, you pay roughly 29% in tax deductions of your total revenue. As a business, you pay 11% of your total income. The main difference between these two income stream structures is you are not in control of when and how much you pay in taxes when working as an employee, whereas you are in charge of when and how much taxes you pay when working as a business. Now you understand the income stream structures. To be able to use debt to pay less taxes, you need to change the way you get paid, to where you are in charge of when you pay your taxes. Recap. Step 1. Make yourself eligible. You do that by choosing to have access to your money before paying taxes. This can be achieved by working as a business or as a self-employed. Step 2. Understand how debts can be used to improve your cash flow. Step 3. Have a clear plan. Here is an example to understand how debts apply to reducing taxes. You are making 60k a year, and your expenses are estimated at 25k. You take a 30k loan on your business, from which you use 90% of the loan to expand your business. How much tax would you pay that year? Simple. 90% of the 30k loan, which has been used to expand your business, equals 27k. This 27k is added to your yearly expenses, making your total expenses 52k. Now, revenue for the year is 60k minus 52k equals 8k. The tax rate is 19% of operating profit, which is 8k times 19% equals £1,520. You pay £1,520 in tax for the year. You may say, but I have 30k debts now. Yes, you do, but you have more assets and capacity in your business, which would enable repaying the loan, and all costs incurred, which are categorized as business expenses, reducing how much taxes you would pay each year. Note, it seems easy to do, but we'd strongly advise getting professional support and advice to prevent getting yourself into debt with no solutions. You can also sign up for our program, Your Money Step-by-Step Guide, to help you begin your financial freedom journey. Step 3. A clear plan on what you are going to do with the additional cash flow to make more money. If you don't have a clear plan, you will spend it all unwisely and find yourself unable to break free from financial struggles. If you enjoyed the video, please like and subscribe to the channel. If you have any questions, feel free to leave them in the comment section. Thank you and stay tuned.